Silver just dropped hard, right as geopolitical tension between the US and Iran is escalating. Oil prices are surging, and inflation pressure is building across the global system. Now pause for a second, because this is where most people get it wrong. In a normal cycle, war plus inflation equals a surge in precious metals, but this time, silver is falling. Why? Because the system is shifting. The Federal Reserve is holding a hawkish stance, bond yields are rising, and liquidity is tightening. Capital isn't disappearing, it's rotating. Investors aren't less afraid, they're just choosing yield over protection, at least for now. And that creates something rare, a disconnect. On one side, macro conditions are screaming bullish, geopolitical instability, energy shocks, long-term industrial demand from solar and EV sectors. On the other side, price action is collapsing under the weight of policy and liquidity pressure. That tension doesn't resolve quietly. It builds, it compresses. And historically, these are the environments where the biggest moves are born, not when everything aligns, but when nothing makes sense. So what you're witnessing right now isn't just a price drop, it's a transition phase, and the real question is what happens when this pressure finally releases. This is where the narrative shifts, and you need to see it clearly. What we're witnessing right now is not just volatility, it's a structural reset driven by liquidity. Silver isn't falling because demand disappeared. It's being pressured because liquidity is being pulled out of the system. The Federal Reserve is holding rates higher for longer, bond yields are climbing, and capital is being forced into instruments that offer immediate return. That's the environment. And in that environment, even strong assets get sold, not because they're weak, but because they're liquid. Think about it. Nearly 50% of silver demand comes from industry, and sectors like solar, electronics, and EVs aren't vanishing overnight. The fundamentals didn't collapse in 24 hours. What changed is access to capital. When liquidity tightens, markets don't reward long-term value, they reward survival. And that's the phase we're in. A forced repricing, a compression, a reset of positioning across the board. So if you're looking at this move and thinking this is the end, you're reading the surface, not the structure. Because real breakdowns don't happen like this. They unravel slowly. This is fast, mechanical, systemic. And that should tell you something deeper is happening beneath the price, and we're just getting started. Now let's go deeper, because this is where the pressure becomes visible. The energy shock is not just a headline, it's a transmission mechanism. Oil prices are rising fast due to the US-Iran escalation, and that flows directly into production costs across the global economy. When energy spikes, margins compress. When margins compress, output slows. And when output slows, industrial demand for silver, nearly 50% of total demand, according to the Silver Institute, starts to weaken at the surface level. But here's the part most people miss. This isn't destruction, it's distortion. Because at the same time, higher oil feeds inflation expectations. And inflation, historically, supports precious metals. So you now have two forces colliding: demand pressure pulling silver down short-term, and monetary debasement pushing it higher long-term. That tension doesn't cancel out, it builds. It creates friction inside the system, and this is where the market starts to feel unstable. Not broken, but stretched. Because when fundamentals pull in opposite directions, price becomes volatile, reactive, almost emotional, and that's exactly what we're seeing. So don't read this as weakness. Read it as pressure building beneath the surface. Because pressure, when it releases, doesn't move quietly. And what comes next depends on which force wins. Now step back and look at the demand signals globally, because this is where the story becomes even more complex. China's manufacturing PMI is sitting around 49.0, still in contraction. New export orders are weakening, global trade is slowing, and on the surface, that suggests declining industrial demand for silver. But at the same time, industrial production is still growing at 6.3% year-over-year, supported by infrastructure and government stimulus. That's not collapse, that's imbalance. In the US, the picture isn't much cleaner. PMI is holding at 51.6, technically expansion, but momentum is fading as higher costs, tariffs, and tighter financial conditions begin to weigh on activity. So what you're seeing isn't a clear trend, it's fragmentation. One part of the system is slowing, another is still pushing forward, and silver sits right in the middle of that tension. And this is where most people misread the market. They look for clarity in a system that's inherently conflicted. But markets don't break when things are obvious. They break, or move, when signals are mixed and confidence is uncertain. So this isn't a demand collapse. It's a demand transition. And understanding the difference is what separates reaction from positioning, because what comes next will depend on which side of that imbalance takes control. Now this is where everything tightens, because price is no longer just reacting, it's being tested. Silver is approaching a major structural support zone between $50 and $60, a level that isn't random. So this isn't just a pullback, it's a decision point. If silver holds above that $50 to $60 support, the structure remains intact, and the next leg could push toward $100 and beyond, even into the $200, $300 range over time. But if that level breaks, the market doesn't just dip, it redefines itself. And that's where we are right now, right at the edge of structure. Because markets don't whisper at these levels, they choose a direction, and that choice is coming. Now here's the part most people feel but don't fully understand. This drop, it's emotional. You can see it in the price, but you can feel it in the market. Retail is panicking, positions are being forced out, and leverage is getting wiped across the board. This is what a reset looks like. Not clean, not logical, just fast, mechanical, and unforgiving. Because when the Federal Reserve keeps policy tight and liquidity dries up, markets don't reward conviction, they punish exposure. That's why you're seeing sharp moves, sudden breakdowns, and no time to react. The RSI was overheated, positioning was crowded, and now the system is flushing it out. This isn't random. This is how markets clear excess. And while that's happening on the surface, something quieter is building underneath. Long-term demand from sectors like solar and EVs hasn't disappeared. According to the Silver Institute, industrial demand still anchors nearly half the market. That doesn't vanish in a week. What disappears is weak positioning. So understand this shift. The market is not collapsing, it's cleansing. And when that process completes, what's left isn't fear, it's structure. And structure is what drives the next move, because after every forced reset, something stronger begins to take shape. And this is where the perspective shifts from reaction to recognition. Because what you're seeing right now isn't just a sell-off, it's a setup. Retail is stepping back, sentiment is breaking, and the narrative has flipped from certainty to confusion. But historically, that's not where markets end, that's where they begin. Think about it. The system just went through a forced reset. Leverage has been flushed, weak hands are out, and positioning is cleaner than it's been in months. This is the phase where smart money starts to move quietly, not loudly. They don't chase strength, they build into weakness. And right now, weakness is everywhere. At the same time, nothing structural has actually broken. The Federal Reserve may still be tight, yes, but cycles change. Policy pivots don't get announced, they emerge. And when they do, capital rotates fast. Industrial demand from solar, EVs, and electronics doesn't wait for sentiment to improve, it continues beneath the surface. So this isn't about predicting the exact bottom, it's about recognizing the phase. Because markets don't reward clarity, they reward positioning before clarity returns. And right now, what looks like uncertainty may actually be the beginning of alignment. And now everything comes down to one variable. The one force that quietly sits above all of this, the Federal Reserve. Because whether silver breaks down further or explodes higher will not be decided by headlines alone, but by liquidity. Right now, the Fed remains firm. Rates are elevated, yields are attractive, and capital is being pulled toward the dollar and bonds. That's why silver is under pressure in the short term. Not because the world is stable, but because money is being redirected. But here's the shift you need to watch. The same forces building pressure, rising oil, geopolitical tension, slowing growth, are also increasing the probability of a pivot. And when the Fed pivots, it doesn't just adjust policy, it releases liquidity back into the system. And when liquidity returns, it doesn't trickle, it floods. Right now, the Fed remains firm. Rates are elevated, yields are attractive, and capital is being pulled toward the dollar and bonds.